Alright there everybody, welcome along to this Wednesday afternoon market recap. A lot to actually talk about over the past 3 sessions since I left you with that weekend market address. If you haven't actually watched that video and you are signing in or at least looking at this analysis video for the first time, I would encourage you to actually pause this to go back and have a look at that late Saturday evening that I posted in regard to the state as to where we are trading out across the board on the US financial markets, also to a broader extent on the global markets as well. Since that video was posted, it's obviously received a few likes and a few comments, so I just wanted to take the time to say thank you. I appreciate all of the feedback and all of the differing points of view. I have read more or less every single comment, and I've looked, into those, into that feedback or into that commentary too. So I just wanted to say that, look, I extend a big thank you to everyone who's taken the time to actually give me their point of view, and it has been overwhelmingly, very positive too. So having said that, let me just jump into what the week has, given us so far, Monday through Wednesday. Let me start with the S&P 500. It is our sort of centerpiece market that we are going to look toward. It is sort of the midpoint of both the NASDAQ and the Dow Jones Industrial Average. It has traded as that way for quite some time. Obviously, you've got the NASDAQ doing a little bit better, and the Dow Jones Industrial Average, relatively speaking, it is further away from its respective swing highs as to where we have been, not only in the month of February, so to speak, prior to the big sell-off, but more recently since this rebound rally that the markets have been in since March 23rd. All right, so let's have a look at the S&P 500. We spoke about, again, over the weekend on any weakness. We were expecting market participants, again, to jump back on in and to buy the dip. That's exactly what happened on Monday. We really didn't see any follow through whatsoever. We saw an original gap down on Monday that very quickly reversed, and as such it flowed into Tuesday. But I just wanted to ask the question, does anyone recognize, if I can move the illustrative tool off my mouse at this particular point, does anyone actually illustrate or understand, can point out what that candlestick is just there and the significance of that candlestick given its location? And I'll just count it down, 3, 2, 1. The answer to that, although it isn't textbook, it does look very similar to that of a Gravestone Doji. It is also very similar to that of a shooting star candlestick as well. Something that we saw, coincidentally, on the weekly chart of the S&P 500 as at the close last weekend. So this is the weekly chart, of the S&P 500. When I go back into the daily chart, that is Tuesday's candlestick. Now, the significance of this is very important. The reason being is because this upper wick over here, once again, it came back on up, You can see the high price of this candle. Pay attention to the H on my screen just here. You can see it was 2,898 points. The low of this candlestick here just to the right was 2,892. So we pushed above it to a margin of 6 points, but very quickly we saw the rejection once again and the complete gap fill, the closure of that, going back to the session dated, the 30th of April, last month, only really a week ago at this particular point. Now, again, since then, and fast forwarding or rewinding through to today's session, we have what we call the one black crow, so to speak. Again, another blended sort of candle. It's not textbook, but you can see the original gap up, and it's traded below, of course, the previous session low. That being on Tuesday, we closed down on the S&P 500 about 0.7%, not the biggest actual macro movement. However, what is very strong and what is very clear is that although we got a very strong acceleration out of the March 23rd lows over here, whereby the markets went parabolic, what seems to be happening since really the midpoint of April through to where we currently are as at the close on Wednesday is that the velocity, is really starting to change its angle. It's more so starting to move. If you thought about a clock face, so to speak, we're probably ascending at a rate very close to where the 1 would be positioned. Whereas at the moment, it's more so looking at a number 2 on the clock face. And depending on where you start this, even if you wanted to take it from the midpoint of April, pretty much we're treading water right now and we're moving towards the 3 hand on the analog clock. So you can see that the momentum itself, it looks to be waning, and it makes a lot of sense because, again, we've got a plethora of overhead resistance, not only on the S&P 500, but really any other market. The NASDAQ excluded at this particular point, which is doing everything in its power to lead the markets higher. And again, it's only just positioned above some of those longer simple moving averages that I will recap for you in a couple of moments. But when you have a look at this on the S&P 500, although we are starting to see again, some little sort of sell-offs taking place, and again, rather ominous warnings, the continuation of those ominous warnings, I still think personally that the S&P 500, although it is trading down here at 2,848, mind you, of course, the market's only really 2.5 months ago, were all the way up here at 3,400 points. So again, we've taken a 15 to 16% haircut so far as to where we are closing as at Wednesday from the most recent all-time highs back on up here in February. I still think that there is potentially one last sort of oomph of a rally, which is going to push this market more or less up 150 points from where it's currently trading at, to come all the way back and up and to retest these critical longer-term simple moving averages. If you pay attention to this as well, we are about to see the 100 cross and push back below the 200-day simple moving average. Price will be back below both as well. So again, I've sort of hypothesized as well the potential of a sell-off to come back down to say 2,720 to really set up that neckline. We'll see how this plays out, whether or not we are going to actually sell off down to this area, say on Thursday and Friday, or maybe even into next week, and then get more so that critical dip or that neck, which I'm expecting to be priced in or set up at this particular point through the guise of chart patterns. But again, even if you wanted to go back to the high, which has been the high price, so to speak, on April, we're still finding rejection, so to speak, at the 10 and the 20 exponentially weighted monthly moving average. Again, this is a big, I'd encourage you anyway to go back and look at the past video that I put out over the weekend, because we spoke about this in more detail. But even if you wanted to take this swing high over here, right, we've got another lower high. So it does suggest that we are going to see some weakness. However, I do believe still that may be the impetus really to set up and to definitively, right, backtest these simple moving averages. Every time we have been in a macro transition, especially on the S&P 500, what has generally happened is that after the first sell-off, okay, generally price action over a prolonged period of time, it'll come all the way back and up. It'll retest these longer term simple moving averages. And generally speaking, that is the best price that you see on the market. If in fact this is a big macro transition, which I think very firmly that it is. I don't think, and what I was trying to suggest over the weekend was that, you know, the narrative that characterized this bull market rally, or the push up of asset prices to extreme valuations, right? A lot of people are trying to return to that same narrative. And what I was really trying to say at that particular point is that that narrative that was driving the market back towards the late period of 19 into the very first sort of 2 months of 2020, unfortunately, that narrative, it's gone. It's not coming back, right? But people blindly are jumping back into the market expecting, or at least not expecting, but hoping that that narrative, that very same narrative, given, of course, the transitional shifts that we have seen around the world, right? They assume that it is going to be revisited. And I beg to differ at this particular point. I think that narrative or that ship has sailed, and we are no longer, right, venturing back to what was driving the market, what was characterizing, of course, in retrospect through to today's session, which was and has been the market top back in February of 2020. I think that's foolish to think along those lines. All right, I really, really do. And again, it just characterizes, of course, right, the psychology of market tops. There are a lot of people up here who had too much risk on, made a lot of mistakes during the sell-off, swore to themselves that they wouldn't repeat those mistakes, and within 1.5 months, now the psychology is shifted to, oh my God, I have missed the most tremendous buying opportunity, right, that's been presented to us in the past decade or so, right? It's a shift in psychology which is taking place. Now you've got the FOMO of a bunch of people, right, not the most switched on, right, active market participants jumping back into the market at all costs, just jumping into what has been, through to this date, a dead cat bounce. And again, very similar to the psychology that was driving the markets up here, this narrative that a lot of people are jumping back on into the market thinking for some reason, somehow, that it's essentially a risk-free market and they're willing to put risk on, right? This is the critical juncture, the turning point up and around this red rectangular box on my screen, where you shouldn't see, right, asset prices break above for any sustained period of time. Yes, we can, of course, linger around this area. I've said give it more or less a 2-month grace period. But even the candlesticks from that weekend video, they really don't ooze a lot of confidence, right? You've got this one bullish candlestick on Monday. You've got the Gravestone Doji on Tuesday. You've got the bearish outside day, sort of pseudo one black crow, as at today's session, creating again another subsequent lower high. Is this going to be a macro lower high on the monthly time frame? I think it will be. But again, these things don't play out, right, in a number of days. It is a big transitional switch, which can take weeks, if not months, to really price into the market at this particular point. So again, I would encourage you to stay very firmly patient, to remain disciplined, allow this market again to sort of stutter around with all of its market noise and opinions. But if you just leave it up and around this area, once we do definitively crack below this little neckline over here, the psychology is going to shift, and it's going to shift very, very quickly again, right? In this particular instance, the downside. No one assumes that these lows are going to be retested. That is every reason as to why you should expect not only are these lows going to be revisited, but they will be taken out during this market cycle, because everyone, more or less, who really isn't conditioned or isn't really, I guess, all that institutional, you could say, right? More so speculative. And when I say speculative, I use that very loosely. What they have their eyes on are these all-time highs. And it really is led by a number, or at least a handful of individual stocks. Again, 5 stocks encompassing the entire 20 to 25% of some of the market indices. It is the most concentrated that it has been since the dot-com bubble. Back at the turn of the millennium, in fact, it is higher now in the concentration of market cap in 5 select stocks. And you can see exactly what is taking place. Even if you wanted to look at this on Amazon, say for instance, obviously, Amazon came out more recently with its earnings. And on the back of that earnings, the stock itself, it sold off about $187 in a session. That is the difference from this candlestick, the final candlestick of April, through to the first candlestick in the month of May. Since then, right, Amazon has stabilized a little bit, albeit marginally. This is only Monday and Tuesday, by the way. And it's doing everything in its power, once again, to close this open window. So think about the NASDAQ, the concentration of stocks, that is Amazon, Apple, Google, Microsoft, and Facebook. Think about a bunch of these stocks coming back on up more recently to close their windows, or being in the process to close their open windows. Wink, wink, Amazon. And the timing of this in consideration to the NASDAQ, which is pretty much positioned right at both the 100 and the 200-day simple moving averages after the first wave of this sell-off. Now, I know it's not going to be perfect. It's not. The NASDAQ, again, is above. You've got the S&P 500 firmly below, with the longer-term simple moving averages about to produce a cross. You've got the NASDAQ, the Dow Jones Industrial Average, which has already produced a cross. You've got price action below the 100, which is positioned below the 200. So again, you're seeing different fractals, so to speak, or different lenses of the same perspective during that of a transitional top at this particular point. Again, very similarly, obviously, to that of the S&P and the NASDAQ. You've got this little bounce on Monday and Tuesday, Gravestone Dojis, outside day engulfing candlestick as at Wednesday's session. The NASDAQ, all right, we've had the initial gap down, largely helped or financed from the actual gap down on Amazon, stabilized a little bit. We've seen a little bounce to produce a Gravestone Doji, now a spinning top candlestick as at Wednesday's session. On top of this, right, although we are above the exponentially weighted, right, daily moving averages, you can see we may be producing some form of that neckline, or the presentation of that, whether this is the neck or this is the neck down here, closer to say 8,250. I assume it's going to be 8,250. So if we do see a sell-off, I'm still expecting something like this to play out. But again, as long as you have your insurance policies there, in the event that this is a very slight double top at a transitional location on the chart, you'll be okay. The oscillators, very overbought. You can see the MACD, it's starting or very close to plateauing and beginning to turn down. The Stokes has already turned. The RSI, the only thing holding this market up at this particular time, and I have to point out the obvious, right, is not the monthly oscillators. You can see that they are only just starting to move. It's more so the weekly oscillators, which again, we never saw the symmetry of the daily come back down to move in alignment with that of the weekly oscillators, right? You can see how these have now turned up. The MACD is about to turn on up, but these are very late to the party. The daily oscillators can sometimes be relatively late to the party in terms of price action, once price action has, right, already moved. So don't think that on the weekly time frame that this is the beginning of a weekly move. This is more so very much towards the end, right? Generally what will happen is you'll get the bounce. It'll look to actually turn back on up and print positive, which is essentially what it has only just done marginally. And at that point on the weekly time frame, you're already back on up into those longer term simple moving averages, which just provides the next leg down on the weekly, which will then confirm, right, the daily, which will then also confirm the big macro picture, which is what you should be most concerned about collectively across these markets. Now, I've just shown you that on the NASDAQ, it is even more weaker again on the Dow Jones Industrial Average, and even, I'd say relatively speaking, as weak on the S&P 500. So again, if you've got the patience to sit through this and let a lot of other people make foolish mistakes, you're going to be okay. Think about a lot of these tech companies. Again, Apple is another prime example. I've shown you it on Amazon, whereby it's coming back on up to close its open window. Say, for instance, at 2,400 points. Apple, right, has got a very similar sort of psychology underway. It's got that magnet pulling this stock price up, and we're just going to continue to bring on up our short. All right, sitting up here just shy of $310 a share. Another boost today. This is the closing prices at Tuesday. What we'll do is we're going to bring this up in due course, look for the reversals in alignment with Amazon, and then that should be the top heavyweight, which is going to begin, right, pulling down the NASDAQ if we definitively see the reversal signals off from these gaps on these big tech companies. Now, again, Apple at this point, it would have still priced in a lower high. Google would have still priced in, right, a lower high. Microsoft, right, still pricing in a lower high. You see how all of this is coming together? You've got these big macro lower highs underway outside of Amazon, obviously, which has been a big beneficiary from this transitional sort of behavioral standpoint of, I just guess, human movement, right? Given, of course, the lockdowns. Once and if this does hold, it's going to be a major blow to the bullish case, obviously, through the eyes of the NASDAQ, the index itself. If in fact we see resistance up and around these areas. Yes, people are calling this an island reversal. No, it's in the wrong location. Generally, you look for this down at support areas. And again, glaringly obvious, we've still got these open windows, which if you've been listening to me for quite some time, you'll understand that those lower windows at this particular point, right, they need to be closed. Character tops or blow-off tops are different. They are what we call reversal gaps. And again, that is exactly what we have on the Dow. That is exactly what we have on the S&P 500. And reversal gaps, by the way, they don't need to be filled. If this is going to be a macro transitional top, this window up here, it doesn't need to be filled because, again, the reversal gap marks the end of that big macro trend. So, again, not a whole lot has changed from that video presentation on Saturday. However, we are still, again, finding more pieces of evidence, right? We're just letting the market move that suggest that it is exceptionally weak. If I go to the weekly charts at this particular point, we've got a little spinning top. On the S&P 500, we've got a little, spinning top, a little shooting star, so to speak. And on the NASDAQ, very different picture here. It looks like an ordinary bullish candlestick. If I go to the monthly chart and just bring up these exponentially weighted moving averages, if I can select the right charts here, you can see, well, I'm in the wrong one. This will be the final thing that I'll speak about as at this Wednesday afternoon market recap. But again, you can see on the Dow Jones, the 10 is now crossed the 20. We're still holding at the 50, but once that gets taken out, that's the neckline that, again, I went back and spoke about during other sort of clinical transitional tops as well. The S&P 500, we've got a little doji here on the monthly chart, again, very early on in the month of May, but you can see that price is still finding resistance at these exponentially weighted monthly moving averages. Again, I still think the door is partially open for a very quick dash on up to 3,000, that psychological round number. How telling would that be if that happened? At this particular point, that's 150 points above where we are currently trading. I just want to be as open about this as possible. I can still very easily see this happening and a lot of people jumping on board with this bullish continuation, or what they assume is a bullish continuation, right at the worst time. No guarantees that we have to get there. History suggests that over time, we are going to get there. All right, we are going to get there. So again, food for thought, but at the same time, I would not be buying stocks at this particular point. There was a worse time since 2016, or a more sort of risky time from that transitional, what appeared to be that macro top back in the period of 15, 16. This is the period right here, I think. However, circumstances today are a lot different to what they were back during, right, that big intermediate correction and retracement in the year of 2016 as well. Having said that, we're only just above the primary trend line. Not that that matters all that much at this particular point, but again, just things to think about at the end of the day too. So I'm going to finish it there for this Wednesday afternoon market recap. If you enjoyed that, have a look into that pro analysis class. Otherwise, I'll see you later in the week or in the weekend pro analysis class too. All the best, everyone. It's James signing off on behalf of Pivot Point Trading. Farewell.